Yeah, we don't have the schedule for and Mark.
Good morning, everyone.
Good morning.
TGIF, TS, and all. So. Love you. My verse for you today, Book of Proverbs, chapter 3, 27 and 28 says, "Do not withhold good from those to whom it is due, when it is in your power to act. Do not say to your neighbor, 'Come back tomorrow and I'll give it to you,' when you are ready, when you already have it with you." This is not just an Old Testament principle, it's a New Testament principle. The brother of Jesus, James, writes about it in his epistle. And theologians have later called it sins of omission, as opposed to sins of commission. A sin of omission is something I didn't do that I should have. One of commission is something I knew I shouldn't do, and I did it anyway. So when we know we should be doing something and don't do it, that too is a sin. And in this Proverbs, it suggested that we should make available, not withhold, from those to whom it is due when it is in your power to act. So, bringing this back to economics, as I always do, a lot of scholars have looked at this and said, if anyone is hurting, you should give it to them. Anyone that you see in trouble, you should give it. I don't see that, because again, from this proverb, as an economist, I should not withhold it from them. Meaning, if they want to buy it from me, I should sell it. I should not withhold it from them. I should not quickly look for a different buyer so that I can get a better price. It's in my power to sell it to them. It's not saying that I must give everything that I have to one. And notice that it says, from one it is due. I have to make a judgment. Do they have the right to what I have and actually need it? Do they have a just need? Solomon is writing in this proverb as well. And so we have to look through these verses and remember first that when it's in our power to act, we should be acting. But it doesn't mean that we have to do everything at a real strong cost to us. Jesus said, "Love your neighbor as yourself," not more than yourself, or totally drop yourself. If you were to always love others more than yourself won't be around too long. You'll empty yourself too much. All right, my thoughts for you on Proverbs 3. Questions on this article from last time. So this was the counter argument to the bull optimism of Mr. Luskin, the PE ratio not being too high. This was the counter argument we talked a little bit about. We talked about Feldstein's four arguments as to why interest rates are going up. Any further questions on that? All right, very good. Oh, and one other article I signed. This is it. Yeah. So we're gonna do more on this next week, as I said. But any questions from reading that article? Justin.
It mentioned that Amazon's held down inflation.
Yeah.
But I don't know if artificially they could determine, but how does the Reserve deal with companies holding down inflation when they're trying to raise it?
That is a big question. They, first of all, does the Federal Reserve, which we're going to talk about today, have the right to somehow try to keep people from lowering prices? Immediately would think, no, they, why should we have it? Secondly, is inflation a problem? Do we want it to be higher? What's the argument behind that? But third, and more relating to our class, would be inflation in what? So Amazon is keeping prices lower primarily for what? What do they primarily sell? Yeah, mostly consumer goods, right? So just stuff that we use in the house for the most part. I don't think you can do it yet. I don't think you can buy a car from Amazon or any heavy equipment or a barrel of oil. Maybe you can. I haven't tried it, but yeah, so inflation again is overall prices. So their effect on prices has been primarily just in consumer goods. And so we're going to talk more about that today. But if I get to it today, it might be Monday. I would argue they're not really keeping inflation down, which is the rise in the overall prices. They're just making consumer goods cheaper. All right. There we go. Okay, no questions on that. We will be coming back to with industry structure quite a bit. Okay, the first article from today that I have for you is about savings, and this is what our class is about. And I will have you read this article. And so we are in a class on savings and investing, and so far we have talked about you can't be an investor unless you are a saver. And you may, and I also talked about you may not want to be an investor because an investor has to have some kind of outlook on the future. The investor, as we talked about, has to take some kind of risk about the future. The saver does not. This article is about how we save. And the primary method for workers in the United States to save is actually through their employers. And what are known as retirement plans, or in particular 401k plans. So 401k, if you're not familiar with that, is actually a section of the US tax code that allows the employer to put aside money for you that they don't have to pay taxes on and you don't have to pay taxes on. So when the employer puts money into an account that's called a 401k account, they can deduct that for their tax purposes as an employee expense, just like your wage. But they're taking income that they would have paid taxes on and instead giving it to you and avoiding that taxes. So they can do that. You, in turn, pay no taxes on that deposit, but you will when you take it out in retirement. So then it'll become income for you, and you'll pay taxes on that. So the whole system, this whole savings vehicle, is tax related. So when the tax law changes, incentives change. And so you'll find in the article that employers are using this way to take some of the tax benefits that they now have, taxes they would have had to pay before that they don't, and they're giving it to employees in bigger contributions, bigger deposits to your employer savings account. Okay, so what does that mean, though, for a saver? So take a look at that article. And so we see the incentives that the employers have to do this now. What does it mean to me as a saver or an investor? Take about 5 minutes to read that article. 5 to 10 minutes. Not very long. All right, first, just a quick personal finance point on this. This issue is one where you have to consider when you're in any particular job whether or not you want this benefit. All right, so as it was referred to in the article, this is an employee benefit. The idea that your employer will pay for your health insurance is another employee benefit. So something that you're being given by the employer above and beyond your wage. Okay, so it's, if you turn it down, this particular benefit, you're essentially turning down money. You'll hear very often, always take what your employer is giving you in terms of retirement benefits. Because if you're not taking the money that they're willing to put into the account for you, you're just leaving money on the table. The article talks a little bit about how employers have moved to automatic approaches to that to force employees to take this benefit. But for a long time, many employees just turned it down. They didn't want the retirement account, and they just left it there. So that's a little bit of an aside in the article. Let's first think about Visa and AutoNation and Nationwide, the companies mentioned in the article. Why do this as opposed to just paying their workers more?
Tax.
Okay, are they getting a benefit for taking the tax that they're saving and putting it in here as opposed to just giving you a higher wage?
Yes.
No, there's no benefit there. But the quote from someone from Visa in the article suggests what's motivating them to give this extra money that they now have to employees in this manner as opposed to wages. What was that?
I want them to ready for retirement so that the young generation can come up.
Yeah, that's very altruistic about them. They're really worried about the future. I'm a little cynical, aren't I? So they say that, but that's not really what it is.
From what I was reading, it seemed like they were worried about retention.
Retention, yeah. The job market is so good now that their best employees are leaving for other higher paying jobs or maybe in a better place, different geographical location. This is a retention factor. So if this employer is putting more into the plan or has put money into the plan already, I have an incentive to stay as opposed to move and start a new benefit program with a new job. So I'm cynical of any altruistic, society's going to be better off because Visa now puts 5% instead of 4% into it. And I don't think so. I don't buy it. But they'll say that, of course, and a lot of people will encourage businesses to do that for it. Your employer really has no obligation to make sure you save for retirement. It's not. They're not really in that business. They're in the business of the products and services that they sell. Okay, so that's the primary motivation that we're reading about here. But so to that same question, apparently we're not saving enough. Do I have to actually invest? And the article talks a little bit about this. So once this money goes into an account for you, you have choices. Your retirement plan, your 401k plan will have different options for where that money goes. Okay, does it have to be an investment? Does it have to go into stocks? No. So just like we talked about before, you don't have to invest for retirement. You could save for retirement. So ignoring retirement plans in the tax code for now, how would you do that? How might you just save for retirement? Just such as, what type of account then would that be? Yeah, just a bank. I leave it in the savings account at the bank, or in a 401k plan, they will have it what they'll usually call a cash or a money market account. Most often it'll be called a money market account, which we talked about before. So money market is the short-term debt instruments of the financial markets, as opposed to capital market opportunities. Long-term debt or equity options would be the capital market. So I can put it in a money market account. So again, I bring that up, and we'll keep coming back to that, is oftentimes our incentive to save is tax-driven, as we're reading here. And we can save for our future goals. All right, so now let's talk about financial institutions. So Visa, AutoNations, Northwest Nazarene University will hire a firm, a financial institution, to facilitate this plan, to operate this plan. They might hire Fidelity. We talked about them before. Schwab, we read about them in another article. Or they might hire Rathbone Warwick Investment Management from Boise, Idaho, which Northwest Nazarene University has hired to operate its investment plan. Okay, so from what you've read before, once your money's in there, what does that financial institution want you to do?
I want you to hire a manager.
Yeah, they want you to move that money that Visa or AutoNation is giving you and put it into capital market. They have an incentive for you to invest. But again, my key point, my key argument is that you don't have to. So our investment firm, Rathbone Warwick, sent a report yesterday, and they do every quarter, that included this graph. All right, so this graph goes back to 1988, good year. So about 30 years back, and is the growth of wealth, they call it. And so if you had $10,000 in your 401k plan, and you invested it these different ways, here's what it would be worth today at the end of 2017. So they send out the reports like this every quarter. If you invested in treasury bills, which is we'll talk about when we do the bond market, which is the primary money market vehicle, the rate on treasury bills generally matches the rate on savings accounts at banks. So this is like a bank account. Your $10,000 from 1988 would be about $20,000 today. Conversely, if you put it 100% into stocks, and their measure of stocks is the Morgan Stanley Capital International, it's a world stock index, so all stocks around the world, not just the United States. Your $10,000 would be about $110,000 today. So it would have grown by a factor of 10, and their firm would have made a lot of money with you along the way. So that, as we read about, So that's exactly what they want you to do. So why do some people choose not to be investors and just remain savers? What is it about that graph that
It's not guaranteed, the risk involved.
right, this is history. It might not repeat itself. You're right. That might be right.
It'd be like the timing. You're, like we talked about Wednesday, if you're older and you have your money, you don't want to put it in,
Why?
risk the chance of losing.
The risk, all right? So the graph shows the risk. So in 1998, my $10,000 had grown to $40,000. 4 years later, it was half that. You know, so that's hard for me. I can't take that. Even if my outlook is still another 20 years or 15 years, I still might not be taken. So the relationship between risk and return. So yeah, I made that, but it was real bumpy ride along the way. So these advisors will generally tell you to split it one of these three ways. So I was talking about a while back new savings programs. You might have heard of Acorn, or where you can take a little bit of money and they'll put it in for you over time. They make you pick one of these portfolios. They call this one aggressive, they call this one conservative, and then you got a middle of the road one. And so they have you split between more risky assets, and so you would think from that most people do this, but that's not what most people do. And those of you that heard Ben Warren's talk in personal finance before, what do most people do? What do you? Most people, as they see this, move all their money to stocks. And then when they see this, they move all their money to cash. And then when they see this, they move it back to stocks. And when they see this, they move it back to cash. They keep going in and out and in and out. And so the average investor in stocks actually makes the 25-75 return. So because we're fickle. So we jump in and out. Very few investors are able for 30 years to just stay 100% invested in the market. So you don't have to invest. If you can't do that, don't. So it just means that to meet your retirement goals, you're going to have to put in more than $10,000. You're just going to have to save more. But a lot of people. A lot of people just respond to the incentives that the financial institution has. The financial institution has an incentive. They get paid more if you're investing rather than saving. So they're going to push you into investing. But if you can't do it, don't do it. It's not in your. It might be in your best interest to just save. If I could invest, then I don't have to save as much to get there. If I can ride that wave for 30 years, then I don't have to save as much to get to the same retirement goal. But if I'm going to be fickle and bounce in and out and worried and anxious, then just save more and you'll get to the same goal. Everybody follow that? Thank you. All right. Any other questions on that article? All right, the other one for today, which I'm not going to have you read right now, but you can go to it at any time today or later. You should probably do it sometime today. It's not in the paper. It's just online on the markets page for the Wall Street Journal. Stocks rise as investors care about the economy, not about politics. Thanks be to God. So we just want to see what's going on in the economy to really know what's happening with our investments. It's the economic issues that matter. couple of things in this article to look for when you go to read it. The oil prices, commodity prices matter. Commodities are inputs to business operations. Jet fuel, plastics are made from oil, whatever. Oil matters, so that's an economic factor. In the article, you'll find out an announcement from China, their latest GDP numbers, gross domestic product, which we'll talk about here in a minute, indicated better than expected growth. The economy is doing better in China than people were expecting it to be. And so that matters. Interest rates matters. The issue on inflation is in this article. Inflation isn't going up as fast as, again, was expected. So that's affecting the stock markets. So the bull market case from Mr. Luskin that we talked about earlier this week is playing out so far in the economic numbers. And the political risk that the United States federal government might take a few weeks off is not as worrisome, I'm all for it, not as worrisome as some had thought it would be. So the economy, as it was told to President Bill Clinton at one time, it's the economy, stupid. And that's what matters for investors. The real economic activity is what drives the value, particularly of stock investments, but also bonds, as you'll read about in this article. All right, so it's the economy that we want to talk about. Getting back to my notes, here they are. So our wrong page. There we go. The primary measure of the economy is known as nominal gross domestic product. And we're going to contrast that with real gross domestic product, GDP. This is the primary measure of how the economy is doing. Gross domestic product is a measure of all the production in the domestic economy. Nominal gross domestic product. I put up that. I didn't put that one. Double check if I got it. Just the one. Nominal gross domestic product measures all the production in the economy at today's prices. Real gross domestic product measures all the activity in the economy today at baseline prices. Why do we care about the difference? Nominal GDP could rise even though we didn't produce more. We just paid the same amount for what we were already producing. So nominal GDP would be going up. So we're not really any better off. We don't have more to consume. We're not working any more than we were before. The nominal GDP simply rose because the prices at which we buy and sell all the stuff we're producing is higher. So nobody's better off. You're really producing and consuming the same amount of stuff, no matter what happened in the economy. So there was no real change in our standard of living or our economic activity. We just kept doing the same thing at higher numbers. That's nominal GDP. Real GDP then is going to be calculating today's production at yesterday's prices. The baseline right now that they're using for prices is 2009 on this measure, but that's not too relevant. What's simply relevant is that when I look at the change in GDP on a real basis, I'm actually seeing whether or not we're producing more. Is there an increase in economic activity in the economy? So it's the real GDP that matters, not nominal GDP. When we talk about monetary policy later on, we'll get to the question whether policymakers want nominal GDP to rise or real GDP to rise. You know, what are they after?
So nominal isn't just like an inflated system. It could be like,
Well, real GDP takes inflation out of nominal. So yeah. But no, nominal isn't a measure of inflation. So nominal is here's what's happening today, and here's the prices at which it happened. Okay, the first thing we want to think about in terms of investing by this measure is what is a good or bad change in our production? You know, what does it mean to say the economy is good or bad? As I said in that article, you're just going to look at the number for China was better than expected, so it was gooder. All right, so it was this turned out. So what does it mean from good? So this is historical U.S. GDP, the change in that, the change in our standard of living, the change in our production and opportunities to consume. What story could you tell from this graph going back to the 1940s? This goes all the way back to the end of World War II. Okay, the volatility has changed, right? So we see that the change in real GDP was wide for many decades, and then since 1980, your lifetime and more, the change has been relatively low. The volatility in GDP has been lower. So economists have actually labeled this. They call it the Great Moderation. And so that our economy used to be more volatile. A term in your reading for this week is the business cycle, the idea that the economy goes through cycles. By this story, we see that the cycle has smoothed out. It's less bumpy than it used to be. It doesn't mean that the drops can't be dramatic. We see that in 2008, 2007, that the rate of change in our production went negative, and you might say dramatically so. But notice that the frequency of a negative change, a drop in production, a drop in our ability to consume, a drop in our standard of living, the frequency of those drops has also declined. So the first thing we can say about the U.S. economy, and we can say this more so about the world economy in the last 10 years, is that the business cycle is smoother. It's less volatile, but it's also less likely that we're going to have a recession or a drop in gross domestic product. The shaded areas in the graph are periods of time that a group of economists from the National Bureau of Economic Research has decided are recessions. So recessions are only identified after the fact, so it's rather pointless. Once an economist tells you we're in a recession, you already know it. So it's really a pointless exercise. But anything that gives economists jobs is good with me. So they gather together and say we're in a recession. And those are the gray areas. So you can see that kind of goes along with the volatility issue. Because the business cycle has been smoother, because there's been less frequent times when GDP has declined, there's also fewer grayer areas. The only thing that you might see that incident 10 years ago, that's a wider gray area than the others. So we stayed in that funk longer than we had historically. So that is one of the reasons that so many books and so many studies have been done on the financial crisis of 2008, because it led to a decline in productivity and output for a longer period of time than had been true in the past. So that's why it gets a lot of that one. So this number, in terms of investing, is relatively meaningless. It's real GDP that matters, and it's the rate of change in that that matters. So getting back to the original question, now that you've looked at historical data from a number of different angles, what's good GDP growth? So this number comes out four times a year. When I'm an investor, what am I looking for? What do I want to see? What's good GDP?
Is it like above zero?
Okay, well, one might argue as long as it's above zero, I'm okay. Okay, so that gets back to Mr. Luskin's point, right, of PE ratios then. All right, so then if it's growing, then a PE multiplier is justified. But I still don't know how much, right? So as long as I'm above a zero, I should be good. But to have a certain PE ratio, I've got to have a certain level of positive, right? So what should that level be?
It says it's about 2%.
The Fed doesn't have any specific number for GDP growth. They do for inflation, that we're going to get to, maybe not today, but they don't have it, only for inflation.
What are we basing GDP comparisons?
Okay, well, we're doing a historical analysis is all we're doing, just in the past. What's good, what's
So
not.
the question you're asking is, what would we consider a good GDP
Right.
growth or not number, but what are we putting it in comparison to?
Yeah, basically the
It's
past.
just the past.
Yeah, what else do you have, right? Well, you could compare US to somebody else. So you might want to look at China's number relative to ours. So you might do that comparison. But no, just keeping the US economy in mind. What's good?
About 5.
Five is going to be your average for a very long period of time. The moderation we talked about occurred here, so you could go to the average there, which is about 3. And so that is what you're going to read quite a bit these days, is most analysts will say if we're hitting 3% growth, we can justify the value for stock investments in particular at 3% growth. We can't at 2% growth. And that's essentially what Luskin's argument was, is that we've been at 2%, but we're headed to 3% because of all the factors that he listed, the tax policy change and the economy growing at faster rates outside the United States. He gave a bunch of different arguments to say that the 2% growth that we had been seeing, which would be down here, is moving up to over 3 or more, back towards the 5 that we would have had back in the, you want to call these the golden years. There was a lot of growth, but it came on and off again. It was a lot of volatility in that. So that was all the hard part about it. So remember, as an investor, you've got to make these judgments. If you don't want to think about that, then you shouldn't be an investor, because you're buying into stocks based on some expectation for what that number and others that we're going to look at is going to be. So you have to make some kind of normative judgment of what's good and what's not. So above 0 isn't good enough, right? So you've got to see what's good and bad.
What would be the factors influencing the more stable GDP?
That's a great question. Yeah.
Government intervention.
Okay, the policymakers want to take credit for it. There was a book written out entitled Maestro, and it was actually the story of Alan Greenspan. And the author claimed that he did that because he was so good at monetary policy. The economy was less volatile than it used to be. Everybody wants to. Bill Clinton wants to take credit for it. Al Gore probably invented it. It's just everybody wants to take credit for this smoother, less volatile economy. But economists can't find an answer. It might not be policy. It might be globalization. See, our economy might have been more volatile because we weren't trading with others as much as we do today. And so that there's a multitude of things. But it's good news. I'm happy that it's less volatile for it. And I disagree with the economists that made that so wide. The actual bad part of that recession, in my opinion, was only about 3 months long. And so everything turned around much quicker, in my opinion, than they thought. One of the reasons they kept it so long is the next numbers that we want to look at. So the next question we have is about employment versus unemployment. So the next key macro factor, key economic factor for investing is the question of who's working and who's not. Policymakers are, particularly in monetary policy today, are very interested in these questions. So there are two basic measures that come out in the United States that investors and the financial markets pay a lot of attention to. It's often referred to as the jobs report. It comes out the first Friday of every month in the United States. So if you actually, if you're on Wall Street, the busiest day on Wall Street is the first Friday of every month. And at about 6:30 our time, 8:30 New York time, the Bureau of Labor Statistics turns out the jobs report. And the jobs report is based on 2 surveys that government agency does. First, they do a survey of households. And the households survey, you are either called or emailed, and they ask you a question. How many people age 16 above in your household? Those are what we call the working population. Okay, of that number of people, how many people are working, how many not? And then the last question is, okay, of those not working, are they looking for work? And from those 3 questions, surveying about 60,000 households in the United States, they determined the unemployment rate. And the unemployment rate is going to be the percentage of adults age 16 or higher that are either are out of work but looking for work. Out of work but looking for it. If you're out of work and not looking for it, then they don't care about you. You're just not included in the numbers. That's true for most of you. You would have to answer that question. I'm not working and I'm not looking for work because I'm going to school. So you're actually considered not part of the labor force. So we don't in this number, we don't care about you. So it doesn't make it feel great. So the unemployment rate then is that percentage of it. So for us, and we're going back to the same time period, that's our blue line. So the unemployment rate today is at 4 point something, just under 5%. So let's do our normative analysis, which again you have to do if you're an investor. You've got to make a judgment call. What's a good unemployment rate? What's a bad? About 5%. And economists have often called that the natural rate of unemployment in the United States. So right now we're below that. That to be normative, that's too low. It shouldn't be there, and it shouldn't stay there. It's likely to go up then, again, if based on historical experience. But you can see at some periods of time, it might stay there for a relatively long period. Here are two cases where it did stay below 5% for a relatively long period. But again, small judgments, right? So what might affect? How might that affect the economy? Well, you read about it today. Visa and those other companies are having trouble hiring and retaining good workers because the unemployment rate is relatively low. So if it keeps going down, they're going to have trouble getting good workers. So these companies are going to have to do what? Pay them more, which means their profits go down, which means you as a shareholder get less. Right? So again, you have to judge whether that is good or bad and how it affects your investments. All right, so also in the jobs report is another survey, and this is a survey of 100,000 businesses, not households, not calling the home, not emailing mom or dad, but actually contacting the payroll department or the human resource department at 100,000 businesses across the country. And the question on this survey is very simple. How many workers you have? One question. And so it's called the employment number, and that's our red number for it. So it's really difficult for us to do it on farms because farmers use a lot of workers at a very short period of time, and then they sit around and smoke cigars or something. I don't know. I was on the cigar thing from yesterday. Yeah. We exclude the agricultural sector for this question. So that's our red line, and it's as a percentage change. So do you have more workers or less than you did before? So this is again the jobs number in the employment report, and so this is the rate of change in that. So this number should be going down when our production is going down, and you see that it does, our shaded areas. Remember, those are our recessions. And so when GDP is declining, so too is employment. If I'm not producing as much because I don't have as many workers. I laid them off or I fired them, whatever it was. Okay, so when this number comes out each month on the first Friday of the month, what should it be? How much change should we see? Let's say good number. About 2.5. The number, if you get real detail, turns out to be 3%. Just that's where we landed with the GDP growth number when we just did this thought process before. So production should be rising at roughly or just less than GDP growth. If 3% GDP growth is good, I'm going to need nearly 3% growth in workers as well. So I'm going to have to see about the same number. It used to be higher. The average was closer to 4, but you see the same pattern in the red line that we saw in the GDP change number before. It was more volatile. See how it has smoothed out in the last 2 decades, more so than it has before. But we never seem to hit that 5% change anymore. We haven't hit it since the early 80s, maybe 1984. That was a great year. Tigers won the World Series. So we have a much lower average, but it's also less volatile than it used to be before. When it's dropped negative, again, except for this crisis, it hasn't dropped nearly as negative as frequently as it did in the 50s or 60s. So that turns out with the size of the population today, a 2.5% or 3% Yeah, it turns out to be approximately 200,000 new jobs every month, given the size of our economy in terms of people right now. So right now, when we look for the next employment report, that first Friday of February, we're going to be, a good number is going to be close to 200,000 new jobs, roughly speaking.
That being because workers are being more well productive.
That's the question. So if I can increase productivity, then the GDP growth number it's going to grow faster than the jobs. But if my GDP is growing faster than my jobs for any length of period, what am I going to have to eventually start doing? I'm going to start hiring more people, even so that they're going to catch up. Yeah, so at some point. All right, so those are two of the things that we have in the economic analysis chapter. We're going to look at inflation and monetary and fiscal policy. Those are the other two trade-offs that when we meet next time. And then we'll get started into the industry analysis section as well. Have a good weekend. Go Jaguars. So we'll see you.
Yeah,
It's anybody that's playing good. If he's even playing. He's got a sore finger or something.
Well, you just
I'm not gonna play
Like Mary out of the ball.
figure.
Yeah.